Reuters estimates U.S. banks have lost over $100 billion in stock market value over the past 2 days. The FDIC, which insures deposits and supervises financial institutions, also took control of Silicon Valley Bank and its $300 billion in assets and deposits. It's the largest bank to fail since the 2008 financial crisis.
Alarm outside headquarters of Silicon Valley Bank in Santa Clara, California today.
They just came out and told us that the bank is shut down.
SVB, the 16th largest bank in the U.S. with $175 billion in deposits, is now the biggest American bank to fail since the 2008 financial crisis. Earlier this week, SVB disclosed it took a loss on the sale of bonds due to rising interest rates and announced it would sell shares to shore up its balance sheet. Its stock price plunged and customers rushed to take their money out. The FDIC now stepping in, telling customers they will be able to access funds by Monday, but the guaranteed amount per depositor? $250,000. Ashley Trunier is the CEO of healthcare startup Farmbox RX. Unable to access her money today, she fears she could be out more than $10 million.
$250,000 isn't a ton of money to us when you're talking of 8 figures that's in the bank currently.
Well, usually you're supposed to not keep more than what's FDIC insured in the actual bank. Usually people invest that kind of money or put it in U.S. treasuries because they're basically guaranteed investments. This is just bad risk management on her part, and obviously this isn't the only place that she has bad risk management. She took a real risk with her plastic surgeon, and she really lost on that risk.
The immediate concern? The cash-burning startups who have millions in SVB and may not be able to access the money they need to pay bills or make payroll.
Deirdre, given what happened today, how much concern is there about the banking sector overall?
Okay, so this is obviously a really complicated subject, but I'm going to do my best to explain it to you guys in really simple terms. Also, we'll listen to some people that are a little bit smarter than me because they can probably clarify a couple things. So Silicon Valley Bank collapsed, and as it said, that was the second largest bank failure in U.S. history and the largest since the 2008 financial crisis. This crisis has been brought on because of systemic risk and the contagion of the Silvergate Bank collapse as well that was brought on by the FTX collapse. But the real thing that's leading these banks to collapse is that they're overexposed to long-term bonds that they bought whenever interest rates were really low. Those bonds are supposed to be risk-free investments, but if you actually have to sell them instead of holding them to maturity, then you could lose money because if the interest rate goes up, then the price moves in the opposite direction, meaning that whenever they sell, they're going to have to sell at a lower price and take a loss. So the reason why all of these banks are failing is because of the extreme rise in interest rates over the past year or so, and it looks like the bond market might actually be starting to break, meaning that the Fed might actually have to do a pivot. Let's find out why. Firstly, let's hear the argument for inflation as per Leo Trades. He had a really good argument in this area.
Over the last several years, banks have been buying bonds, essentially with zero interest rates and free money being chucked into the economy. All the banks were taking all the money and chucking it into bonds to earn some yield. So all the deposits they were receiving, they were putting into the bond market. Well, what happened when they started raising rates aggressively is actually we got the stock bond correlation where both stocks and bonds started falling in unison. What's going on right now? Effectively understand this. Tons of banks all around the United States and the Western world are sitting on unrealized losses from these bond purchases. Those bonds have completely sunk in value, but they didn't have to sell those bonds until there's a run on the bank. So what happened over the last few days is that there's been runs on the bank. It started with Silvergate Bank, and this was partially because we got a tweet from a senator, Elizabeth Warren, claiming that the bank was insolvent, and that caused a run on the bank in Silvergate Bank. Of course,
she should honestly be locked up for that. Like, how is that even legal? It's supposed to be illegal for them to do insider trading, and then just collapsing the whole banking system, is that okay? It's not really surprising to me that Elizabeth Warren would somehow be responsible for the collapse of America, but I digress.
Of course, there were ties to FTX and all that stuff, but being completely honest, this is an absolutely insane thing for a senator to do, for any politician to do, to push for a run on a bank and then claim that this is crypto's fault. It's absolutely unthinkable, but that's what happened. So you're having that happen over there at Silvergate. Now we're seeing something similar happen at Silicon Valley Bank, which has nothing to do with crypto. This is not a crypto bank, right? And so what we're seeing now is other banks start to show weakness. And all of a sudden, yesterday, the financial sector woke up to the fact that there are tons of banks all around that are sitting on huge losses from their acquisitions of bonds. So what you're
Also, I think that a lot of people don't even understand any of this stuff, and if they hear that there's bank runs going on and that the bank system might be unstable, then they're probably just going to go pull out enough money at least to pay their rent for the next month or so, just in case they can't pull it out whenever the time comes. Just the mere mention of bank runs can actually cause bank runs, and this can collapse the whole entire banking system.
So remember, people put money in the bank buys bonds. And that was the way that they processed most of their transactions for a significant amount of time. Now, all the banks know that they're down on these purchases, but they don't really have to realize the losses. They don't have to sell at a loss. Think of it as selling at a loss until enough people request to get their money out. So that run on the bank forces them to then lose the money officially. It's gone now, and those losses are what's called crystallized.
So basically, this is happening because nobody wants to buy bonds, and this is about to get a lot worse because right now, with the Fed unloading and trying to reduce their balance sheet, they're putting a lot of bonds on the market, which aren't being bought up already. And then with all of these banks having to collapse and then sell all of their bonds, this is just flooding the market with more and more bonds that nobody's going to buy. So this is causing pretty much extreme monetary tightening, and this could lead to a debt crisis and more banks to collapse. So the Fed is probably going to have to come out and start buying these bonds up again, meaning that they're going to have to do quantitative easing and go back to printing or do a pivot.
That's what's happening right now, is that Silicon Valley Bank was forced to crystallize a ton of losses to process withdrawals. It happened at Silvergate Bank as well. So Silvergate Bank got liquidated, and right now we're not sure what's going to happen with Silicon Valley Bank because it's a much larger bank. $169 billion was the figure that I heard. I believe it's over 160 billion, and it's the 18th biggest bank in the United States. How you can keep your money safe right now in this situation, right? The number one, least risky way, I believe, from my understanding, again, I'm not an expert in this, but buying U.S. short duration T-bills is effectively a way that you can have your money with the government. You have your money essentially being owed to you by the government. There's no limit on that insurance or protection, effectively, unless the government defaults, right? Unless the government defaults and the United States government doesn't print money and pay back its debts like it has throughout the entirety of history.
I would agree with that, but I think that actually you're probably safe unless you have more than $250,000 in your bank account, because that's also insured by the government through the FDIC. If you have more than that, then yeah, probably short-term T-bills are going to be the way, because the government's probably not going to be defaulting on their debts right now, and that means that you're probably going to be able to hold your bonds or T-bills until maturity, and you're pretty much guaranteed that your money's not going to evaporate. But I think that as long as you have under $250,000 in your bank account, then it'll probably be fine. You just might actually not be able to pull it out of the bank whenever you want to, so it probably might be a good idea to keep a little bit of cash on the side. Just like the Silicon Valley Bank people aren't able to pull their money out, but the FDIC says that it'll be available on Monday, you will eventually be able to get your money, but you might just not be able to get it exactly when you want it. The big problem with that, though, is, of course, if there's no money in the bank and there's a liquidity crisis, and then the FDIC has to pay out all of these people for insurance, basically, then that money has to come from somewhere, and I believe that that means that they're going to have to do printing again. So whenever you do get your money back, eventually, it might not be worth as much as it was whenever you first put it in the bank, obviously. And for that reason, I'm pretty glad that I have most of my money in Bitcoin and other cryptocurrencies. Remember, this is exactly why Satoshi Nakamoto created Bitcoin in the first place.
Your money is still owed to you. It is not inside of a single bank that is doing fractional reserve banking. That's not where your money is anymore if you've bought T-bills.
Another big problem on why the banks are having a liquidity crisis is because they actually don't do fractional reserve banking anymore. At the beginning of the pandemic, that was suspended, and the banks still don't have to hold any reserves on hand. Previously, they had to hold at least 10% of deposits on hand, and that meant that whenever you went to go pull your money out of the bank, there would at least be 10% of your money in the case of a bank run. But right now, that's not there, so if you do go try to pull all of your money out, there's just no money at the bank. And this could definitely make things a lot worse.
I've been employing the T-bill strategy here for just because the rates are so good, you're earning over 5% just letting your money sit there. It's not too bad, right? So what happens now, essentially the issue is that there's not enough people buying bonds. And when more people buy bonds, that would normalize this process. That would essentially fix the issue. But structurally, that's a lot of money that needs to be bought. But what happens if a ton of banks start to fail? You get civil unrest, you get effectively protests, and you get demands for the government to bail out the banks once again. However, I believe the way that they're going to do it, and remember, we've said all throughout 2022, something will have to break for the Fed to really jump in and do something differently. Something has to break. To me, banks failing is something breaking. It's the biggest possible thing that you could see break, right?
That's what I was saying in my last video. This is exactly the kind of thing that everybody has been waiting for. The system is starting to break, and there's not really much that the Fed is going to be able to do beyond this point.
So if we see these banks fail, like it looks like these are smaller banks, right? 18 out of whatever. This isn't, your top 5 banks, but still, this is a huge, huge problem, right? A huge problem. The biggest bank failure since the Great Recession. Okay. So,
and the second biggest in history. This is a really big deal. He's not wrong.
If this continues, what I expect to see happen is the government will start to print money to buy the bonds, right? So they'll do what's called yield curve control, or they'll start buying their own debt. Right? And that's circular, and it creates a huge inflation problem. But effectively, this is something that I believe will be the only it's tricky, right? Because it's going to hurt inflation. It's going to send inflation higher. But if they start doing this, so as much as like what's happening right now is going to cause a huge panic and something looks like everything could be going miserably wrong, my belief is that the government will try to fix this at a certain point. They're not just going to let every single bank fail, right? That doesn't make sense, right? You end up ruining the country.
Yeah, if banks fail, then people aren't able to pay their rents. They're not able to pay their obligations or their debts, and everything will just absolutely collapse. As I've said in the past, there's not really any option for the Fed. They're eventually going to have to continue printing because we have almost unlimited debt now. It's absolutely mind-boggling. Everybody was expecting that the Fed was going to come in and tackle inflation by raising rates to above the rate of inflation, just like Volcker did. But like I've said in the past, we have way more debt than we did back then, and there's no way that it's going to be serviceable if we have interest rates so high.
So, in my opinion, what will happen and what people should be looking for is looking for the pivot where the government starts to intervene. Anytime, any type of intervention into this process could cause massive amounts of new investment and shifting back to a risk-on climate. Think of what happened.
The only thing that I'm worried about with that is that risk-on usually means stuff like tech, and if tech is really being so impacted by the tech bank, the big tech bank of Silicon Valley going down, then maybe people won't trust the tech companies or feel comfortable investing in them.
Happened in the COVID crash of March 2020 crash. Everyone thought everything was going to zero. The government stepped in with essentially an infinite amount of money, and all of a sudden everything had the biggest, most insane wet and wild bull run of all time. Now, I don't know exactly what's going to happen in what proportions, but I do believe that I've outlined a few really, really important things here. So this is a big deal, right? This is current today. It's Silicon Valley Bank. We don't know which other banks are in trouble, and I'm not really an expert in that, but I'm just
Yeah, I'm not an expert in that either, and I don't really know what banks are in trouble, but I think we're going to start finding out on Monday. Right now, while the traditional markets are closed, we have a little bit of time while everybody's trying to figure everything out, but this systemic risk is probably going to continue to accelerate, and we might see the contagion take off on Monday, with the Fed actually having to come out with an emergency meeting and maybe even do a pivot next week.
Explaining to you what I understand happened at Silicon Valley Bank. Now, the second thing I talked about is a strategy, which is if you have cash in a bank account, I highly suggest, or at least I understand, I'm not a financial advisor here, but I believe the best, safest thing to do here is to have your money in T-bills, because that's
I would say that a good idea is possibly to even have a little bit of money just put aside in cash, which I mean like actual physical cash, dollar bills, and not T-bills or in the bank, because if the bank does have a liquidity crisis and they actually have a run on the bank, then you might not be able to get your money out right now, and you do probably have some bills to pay in the meantime while the FDIC figures out how to get you your money.
Direct IOU from the government. It's not from a bank, and banks can go under. Again, we do not expect the government to go under from this. No, they'll be forced with a choice to print or let something bad happen. And in my opinion, they will choose to print because that is much worse than the alternative, or much better than the alternative. So what this means is that this will cause more structural inflation. However, it should create a huge, massive surge in asset prices, of course, like Bitcoin and S&P 500 and all the other stuff we saw, right? But I believe that if this continues to be widespread, that we'll see the government intervene. And when the government intervenes, this will lead to, or in the moments leading up to the government intervening, we could see prices go into free fall on Bitcoin, S&P 500, everything. True panic. And that is where you'd expect some government intervention, much like what we saw in March 2020. I don't know how bad it's going to get. So I'm not saying, hey, here's a price target, nothing. I'm saying, here's my general mental mapping for the next few weeks, months. I'm just going to be watching this, keeping a lot of money in T-bills and understanding that there's all kinds of systemic risk, not just in crypto, right? I can't believe a senator would tweet to cause a bank run of a bank.
Yeah, it's absolutely insane. We're pretty much in uncharted waters here, and I have made some price predictions in the past and said that we probably won't be making another lower low, but I'm not really sure right now. I do believe that my money is probably the safest in Bitcoin because it's not exposed to inflation risk like the US dollar is. There's no way that the Fed is going to print a bunch of Bitcoins to try to get us out of this situation. They're just going to continue printing dollar and debasing it out of existence. But he was right on that situation that we could be seeing some free fall in the markets until the Fed actually does come out and do some saving of the markets. But I do think that it's probably not going to be making a lower low in my opinion. But I could be wrong because as you can see right here, for one thing, USDC, which is supposed to be obviously US dollar coin, is not a dollar anymore. It's 91 cents at the time of recording. And even Binance is at 99 cents roughly. So we could be seeing all of these things collapsing, and that would definitely put a lot more fear into the markets, which could have us making some crazy movements to the downside. However, I believe that this is only going to be temporary because, as Elio was saying, the Fed is probably going to have to print, and ultimately, Bitcoin and other cryptocurrencies and hard assets really are going to be where all of the money goes. And if you're trapped in US dollars, then all of your net worth might just evaporate.
I can't believe a senator would tweet to cause a bank run of a bank. Now we're seeing that it has nothing to do with crypto. There's tons of banks all around the United States that are in true danger. And it feels like a little bit of misdirection that's been going on, trying to focus and make crypto this big bad actor, when in reality, the issue that we're seeing is, essentially
too high interest rates. Really, it's the Fed that's destroying everything, not crypto. Crypto is just a scapegoat.
Mismanagement from the Fed. The Fed can't win this. They either need to let banks fail, a situation that they created with their easy money to hard money policies, or they need to print and create more inflation, which goes against everything that they've been trying to do. They don't really have an easy W here. I wish I was being dramatic here. I'm not. This is what's going on. We were expecting something to break. Something's breaking. Now we get to see how this plays out, right? And how it plays out, if you understand a few chess moves ahead, you can see where the risk is most likely going to start becoming where money flows back to if the government starts intervening and buying its own debt, because that becomes cyclical. It's like what they did in Japan. It creates huge inflation. This is a structural economic issue that Bitcoin was literally designed to hedge against. So here we are. It's game two after the Great Recession, and things are starting to really break. So it's crazy.
There's a great video by Elio Trades. He has some really great information, and he put that in really great terms that almost anybody could probably understand. Now let's explore the other possibility. Here we got a video by Reventure Consulting, and he thinks that there's going to be a deflationary depression, which is basically the opposite of what I think is going to happen.
I just want to say I understand that saying words like depression and banking crisis can sound alarmist, and I'm not trying to be alarmist here. I'm merely connecting the dots on the data that's available in the economy right now. And what's scaring me right now, and what should be scaring you in the economy, is that up until yesterday, when this banking crisis in Silicon Valley hit, no one was talking about this. No one was talking about the chances of a banking run, but now that's becoming a lot more obvious. Ultimately, the way that this will impact the economy, if it plays out the way I think it will be through deflation. We're going to see, actually, contrary to the crazy inflation we're seeing right now, we're going to see a shortage of dollars and a shortage of cash in the system. And the bank run that started in Silicon Valley could happen to other banks around America. And that
I think that this actually could happen. We could see a short-term deflationary panic, basically, but the Fed is going to have to come out and eventually continue printing, and they're going to have to do quantitative easing, which will cause inflation to rise again. We just might see a little bit of deflation until they do come out and pivot. We'll see when that happens. And as we know, their rate hikes or cuts work with variable lags, so it might actually take a while for those cuts to take an effect on the market and for deflation to stop and inflation to tick up again.
investors are fearing that we could be seeing other bank runs. The bank doesn't have the cash to fund those withdrawals, and that's ultimately what creates a banking crisis and a depression. Because if we go back to this graph that I showed you earlier on the change in money supply, we talked about how the money supply is contracting right now. Let's talk about the 4 previous times the money supply contracted. Once in the 1870s, it contracted by 2%. This was called the long depression of the 1870s. The unemployment rate went to double digits. We had big deflation. Then it happened again in the 1890s, in the panic of the 1890s, which was another depression where the unemployment rate went as potentially as high as 18%. Then we had the depression of 1921, where the money supply contracted by 2%, and we had the unemployment rate go over 10%. And then, of course, we had the Great Depression. In all of these instances, we had bank runs, banking crises, high unemployment, and deflation, which means, I think in 2023 and 2024, the odds of that are increasing significantly. And I'm not.
There is a big difference between now and before the Great Depression. If it wasn't for the FDIC and the Fed, I think this would probably be the outcome. But now we're probably going to be seeing something different because they're just going to continue printing. In 1907, a particularly severe panic resulted in a bank run that wreaked havoc on the fragile banking system and ultimately led Congress in 1913 to write the Federal Reserve Act. The Federal Reserve System was initially created to address these banking panics. In the past, we have seen these bank runs, and the Congress basically said that they don't want to see this issue anymore, and they think that they can control it. So they created the Fed, and their job is basically to print money whenever we do see a situation like this so that we don't see a deflationary depression. Also, this is why the FDIC was created, because back during the Great Depression, people did see their banks collapse, and a lot of wealth was actually just erased, and all of that deflation did lead us into the depths of the Depression. But yet again, the government thought that they could control all of this and that they knew better. So they created the FDIC so that we can just print money and pay people back in dollar terms the money that they lost whenever the banks collapsed. But whenever they do actually get their money back, it's going to be worth a lot less because all of that money has just been injected into the system and the actual value of the dollar has been debased. For this reason, I don't think we're going to be seeing a deflationary depression. I think the Fed and the FDIC is going to step in, and they're going to have to continue printing out money, and this is going to lead to possibly even hyperinflation.
To have some money in cash on you, in your house, in a safe place, maybe it's $1,000, maybe it's $2,000, but enough money that if, excuse my language, hits the fan, you will be able to survive for a couple weeks, for a month, until inevitably, if this happens, the Federal Reserve and the government will come to the rescue. They're going to reverse everything they're doing and try to do another bailout and print money. But in the interim, it could get messy. And there's a chance at some point later this year, you might go to your bank and maybe you can't take the money out. Or
I don't know if it's going to take till later this year. I mean, everything this year is later this year, even tomorrow. But I think it might be more like next week whenever things start to actually collapse. I could be wrong, and maybe some of these banks can hold out longer than I'm thinking, But I think that this is pretty much a systemic risk that's going to continue to ramp up. And the dominoes are going to fall as one bank can't pay back another bank's loans, and they just continue to default and have to sell these bonds, crystallizing their losses and ultimately needing a bailout.
There's another thing you got to think about here, folks, and that's the fact that not only is the Fed contracting the money supply through quantitative tightening, they're also increasing interest rates. And the more that they increase interest rates and the yield on treasuries, the more they're incentivizing bank depositors and people who are saving money to pull their money from the banks and to put it in U.S. Treasuries. It was a 5% return on a one-year U.S. Treasury. Now it's gone down to like 4.7, 4.8, but that's still much better than you can get in a bank in your savings account. So that's something, the shift of depositors away from the banks and into the Treasuries, that's something that could destabilize the system even more.
Definitely something to consider there. But like I said, as these banks collapse, they're going to have to continue liquidating their bonds. And as the market continues to be flooded with all of these bonds that nobody wants to buy, it is possible that other countries might even start to offload their bonds as the Fed keeps on printing money and everybody starts to lose faith in the US dollar as the world reserve currency.
And what's also new is the fact that we have so much debt as a country. Right now, the federal debt to GDP ratio is 103%. There's a $27 trillion debt bubble here in the US government, and that's more than the GDP. That's more than our economy produces in a year. You could see that's double the long-term average of the debt to GDP ratio. I'm seeing a scenario now with rising interest rates that makes this government debt burden not so feasible. I mean, when short-term interest rates were 0 2 years ago, the government could borrow a lot of money and they didn't really have to pay much in interest. But now with short-term interest rates of 4 or 5%, the government's burden on paying interest is going to go up a lot, and that's going to constrain their ability to take out more debt, which is something that could cause the economy to go south. Because without that continued infusion of debt hitting the US economy, consumers are going to run out of money. I mean, they're already running out of money and having to resort to their credit cards, and they have a record low personal savings rate. So that's concerning.
So as these banks collapse and the Fed continues to reduce their balance sheet, this is basically flooding the market with bonds and causing essentially hyper monetary tightening. This could lead to a depression that is deflationary if the Fed doesn't do a pivot. As these bonds continue to flood the market, it's going to continue pushing the price down, and this might lead more banks to collapse, and it might cause countries to lose faith in the US dollar, making them offload their bonds as well and flooding the market with more bonds, making it pretty much impossible for the government to borrow money. This could lead to a debt crisis and make us default on our debts. And in that situation, as our AI overlord says, a government default could lead to a decrease in the demand of the currency and an increase in the supply of the currency. As creditors may start selling off government bonds and avoid investing in the country, this increase in the supply of currency relative to the demand for it could lead to a decrease in the value of the currency, which would lead to inflation. But on the other hand, a government default could also have deflationary effects if it leads to a decrease in the government spending and a decrease in overall money supply. If the government has to cut back on spending due to the default, it could reduce the amount of money circulating in the economy, which could lead to deflation. In my opinion, it's pretty obvious why we're going to be seeing the first one, but let me try to explain it for you. As I asked our AI overlords, has a government ever done the second one? It said yes. There have been cases where the government default has led to a deflationary effect on the economy. In the Greek debt crisis, which began in 2009, it resulted in a default on the government debt in 2012. Following the default, the Greek government was forced to implement austerity measures to reduce the spending, which led to decrease in the money supply and deflationary pressures on the economy. Essentially, one way for them to deal with this would be to default on the debts and actually to reduce government spending and the money supply. But for one thing, the money has already been spent. We're $31 trillion in debt, and this debt has to be serviced with interest. Also, if you thought that was bad, this is even worse. We have $182.1 trillion in U.S. unfunded liabilities, and that means stuff like Social Security. Essentially, this money has already been spent because that's how debt works. Basically, you're spending money from the future and borrowing from future economic production. So even if the government came out and stopped spending money tomorrow, we still have $182 trillion worth of stuff that we have to pay for, and that means that the government just can't stop spending. It said another example is the Argentine debt crisis of the early 2000s, which resulted in a default on the government debt in 2002. Following the default, the Argentine government implemented policies to reduce spending, which led to a decrease in the money supply and deflationary pressures on the economy. But as we all know, this didn't last very long because they've definitely been dealing with hyperinflation over the past decade or so. So even if we do see some deflation in the short term, eventually it's going to continue to lead to inflation and possibly even hyperinflation here in America. So in summary, as these bonds continue to hit the market, it's making monetary conditions even tighter and causing even more of a liquidity crunch for these banks, making it even more likely that they are probably going to have to sell their bonds for a loss, crystallizing those losses, and even possibly leading to more bank runs. For this reason, I think the Fed is going to have to pivot, possibly even next week, and they might even do an emergency meeting. Some people think that they might pause or that they might slow down the interest rate hikes, but I think that if they do that, then as they've always said, the interest rate hikes do work with long and variable lags. So if things are breaking right now, whenever these interest rate hikes that have happened over the past year or so actually come and hit the market, then we're going to be seeing things collapsing way worse than they are right now. And I think the Fed is going to have to try to preemptively avoid something like that by coming out and doing a pivot and probably losing all credibility, even possibly next week, like I said. Even if they don't do a pivot next week, I think that they're probably going to have to do a pause at least. And then whenever it does come to the debt ceiling and we have to actually raise the debt ceiling or default on our debts, which I think is supposed to happen in July, they are going to have to continue printing, or else basically America is done. Let me know what you guys think in the comments. Is the Fed actually going to hold strong and continue raising rates, or maybe even hold them high, maybe even leading to more bank runs? Or are they going to come out and pivot because, like everybody has been expecting them to, something finally broke and that's what they got to do? Either way, thank you guys so much for watching. I hope you have a wonderful day, and hopefully our banks aren't all frozen by the time you guys see this. I'll see you guys next time. Bye.